This episode is brought to you by Raymond James. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors. They've got $88 billion in assets under management and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Now, whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We are doing our CEO Summer Series, and today we're featuring David Kassie. He's the Chairman Emeritus of Canaccord Genuity and the Executive Chairman of Outcome Metric Asset Management. But to many on Bay Street, he is just known as a legendary deal maker. His whole career he spent primarily as an investment banker, building CIBC's capital markets division into what it is today, before going on to found Genuity, which ultimately became Canaccord Genuity. And we talk about a bunch of war stories on Bay Street to present day. What does he see as the biggest concerns in the market and in the country? Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. David Kassie, thank you so much for joining me on the podcast.
Pleasure to be here.
You are one of the biggest deal makers on Bay Street. Is that fair to say that?
I've had my moments.
There's a thing that investment bankers get every time they do a deal, right? They get not a plaque, but they call it a tombstone.
Yes.
Do you know how many you have?
No, but I'm sure as well in excess of 100, if not a lot more than that. But most of those would have been from a long time ago. I sort of stopped getting them, except for the most notable deals.
I mean, they're all from deals that many people would know today: Four Seasons, Global Crossings, which ended up being huge for you guys. But certainly back in the day, I don't think there was a major deal that you guys didn't touch.
If we're talking about CIBC World Markets, you're right. We had a very strong market share starting in the mid-90s. And, by the time I left in 2004, we were, certainly the dominant Canadian dealer. And back in the day at Wood Gundy, which is kind of where I grew up, my career started, we had a dominant market share for most of the first 10 years that I would have been in the business.
You kind of gave a little bit of your resume, but if you'll permit me, you started at a bank, but there was an entrepreneurial streak, it seemed to you, even at the bank, where, it might seem like it's not all that crazy today, but these two units, banking and investment banking, didn't really live together. And you made that happen at CIBC. And you could have probably lived out a very nice career there. And then you went and you started up Genuity, which many people will now know is Canaccord Genuity. Did I kind of get the order of that correct?
Yeah. I mean, starting with Wood Gundy before CIBC bought Wood Gundy. Yeah.
I feel like in finance, you can take two tracks. You can take kind of a safe bank track. You're in the management trainee program and you can advance, in a steady pace if you're competent at your job. But then you can take your track, which is a little bit more entrepreneurial. Can you speak to what drives that side of you?
Well, it wasn't a plan. I guess after CIBC bought Wood Gundy was the first time that I kind of veered off the straight path, if you will. A little bit at Wood Gundy when I was working on all the British privatizations, which was unusual for somebody there to spend so much time out of the country and overseas. But after CIBC bought Wood Gundy, I decided I didn't want to do investment banking anymore. Part of it was personal. I was about to get married, probably start a family. I wanted more control over my schedule. And not to have to respond to clients saying you need to be here tonight or tomorrow morning and get on a plane. And part of it was professional. I decided I wanted to be a principal and have a different experience. So really, it was just reacting to that personal circumstance and professional feeling that I wanted a different experience at that time that caused me to do that. The second big change was having built and run the merchant bank for almost 5 years. I was asked to take over investment and corporate banking, which was really a strategy and business building job, particularly the part outside Canada, but rebuilding what was in Canada because CIBC Wood Gundy had fallen basically to last place as many of the Wood Gundy partners had left and checked out. So that was basically responding to a request by partners, if you will, to, build the business. And, so that was a very different experience, but it wasn't a long-term plan at all.
And yet you kind of spent most of your career in investment banking, despite your best efforts, it seems, to get out of it.
Yeah, I dealt with a lot of clients. I really like investment banking. I think I like the principal business more, but I really liked investment banking and the idea of helping clients and being the trusted advisor.
So much of that is about deal making. And it's funny, with President Trump in office, everybody's trying to figure out what is the art of the deal. The art of his deal seems to be a little bit of chaos, distraction, and then securing terms sort of after that with people maybe feeling unstable. I don't know that was your approach, but I wonder, as somebody who, made his life on deal making, how do you think about the art of the deal or the way to successfully negotiate terms?
Well, I'd probably depart on, I do not believe that deal making is a zero-sum game. Obviously, there are certain elements that by definition are zero-sum, but I'm a big believer in win-win. Both sides often have objectives, and it's about finding the place that works on a deal for both, myself or my institution or my client, and as well as the other side. It's in my experience, a very small world. And, one thing I learned, in I think it was a negotiation offsite session when I was like 4 or 5 years into the business, the most valuable asset you can have as a deal maker is to be trusted by the other side. That is a huge currency. And if you're not trusted, it's really hard to make a deal. So in order to do that, you have to live by your word. You have to do win-win transactions because you keep running into the same people over and over again. And if your job was to screw everybody, you'd quickly find yourself out of people to deal with in a short period of time.
What did get you fired up then about deal making, about the business that you were in? Because I imagine that, some people are very impressed with wealth. And that's what drives them getting to be part of like an exclusive Bay Street club or Wall Street club. So it's interesting. It sounds like whatever drove you was something else.
Well, the investment banking business, at least when I started, and probably still obviously today, was very much about winning the business.
So you're competitive.
Yeah, yes. I'm probably a little less today than I was growing up. I came from a culture of sports where, I played varsity basketball for 5 years, et cetera. So very much part of my mean, if you will. But winning. But probably the most important thing to me was being valued as somebody who provided a really good advice, differentiated advice, and a great outcome for the client, if you're talking about investment banking. And on merchant banking, it was about having a great outcome, for both my organization and my partners, because we often had partners in the deal when I was running and building the merchant bank over 15 years. And then we had a private equity fund at Genuity. So, I think it's about, having a plan and being successful and executing and, having a very happy client or partner.
Many Canadians are looking for steady dividends and long-term growth. This one could be for you. Diversified equity income strategies focus on high-quality companies that not only pay dividends, but grow them over time. So that means a regular cash flow and real potential for capital appreciation. Middlefield has managed its Income Plus fund for over 25 years. The fund leans into dividend-paying sectors like REITs, healthcare, and energy, with an eye on downside protection for when the market becomes volatile. It's all about balance, flexibility, and staying positioned for what's next. To learn more about equity income investing, visit middlefield.com. Well, what's your biggest win? When you look back, I'm sure you've had many, but what stands out to you?
I guess in hindsight, I forget who said it, but an achievement can only be measured by the obstacles one overcame. I can't remember if that's Thoreau or Emerson, but one of the two, I think. Probably the biggest win was the early success of Genuity. That was a startup. If you've never done a startup, it's for a lot of people, that's very daunting. You literally have nothing. You have no space. Well, actually, you were probably experiencing it yourself. I kind of know
something about it on a smaller scale. Scale.
Yes, you do. But I had 100 people, joining us the first day with a payroll, et cetera, et cetera. We had a plan. I guess the most satisfying thing is it probably was, obviously we had a positive result ultimately, but, out of the box, well known, we got sued, which, frankly, none of which, had to do with reality. But
just the backstory is a lot of CIBC people ended up coming there, right? And CIBC was getting
nowhere near as much as people think. We had about 100 people to start with, and off the top of my head, I'm going to say 20 only, 25.
But you're starting up a business.
Out of 100 were from CIBC, so I completely understand at the time why they wanted to deter other people from leaving because they didn't know how big a firm we were going to be. But putting that aside, from a standing start, we got to a result, albeit in our third year, so from zero, where we did over $200 million of revenue and a profit basically of effectively of about $60-70 million in our third year from zero. And at that point, if we had gone public, we probably would have been valued close to $1 billion. So to start something from zero to 3 years, now the financial crisis happened and revenues went down, obviously, et cetera. But we ended up doing fine. But that felt like an enormous accomplishment in a 3-year time frame from zero to $1 billion.
And you had headwinds, as you mentioned, the CIBC lawsuit. I was doing some reading from that time, and quite frankly, the press was not super favorable towards you. I don't know if you read your own press, but did that weigh on you?
It didn't because, it weighed in as much as you're always concerned, obviously, when you're starting a new firm, of people's perceptions. I knew what the truth was. So, no, it didn't weigh on me that way. Ironically, we actually initially got very favorable press. And then I know CIBC went to the media and said, if you want us advertising anymore, you need to be more balanced. And that's when the press, got a somewhat negative.
So you mentioned you got that early success. It was hard, but the first 3 years, then you hit the financial crisis. What was it like as still a startup experiencing that kind of volatility and uncertainty that the financial crisis brought?
Ironically, we were, I was pretty fine because we had no debt. We had a very, in the grand scheme of things, compared to revenue and earnings, we had a very, very low overhead. So the only question was, okay, so people's bonuses are going to be less this year. Like, that's not the end of the world in the grand scheme of things. Having lived through, by that point, many ups and downs of markets. I lived through the 87 and, the dot-com bust in 2001. So, a lot of experience. So I wasn't very, very concerned. We had some people who were concerned. So I found myself, I was doing semi-annual discussions with people, regardless of it, meeting with each of the partners and junior partners, of how are we doing, what would we do differently, et cetera. And there were at least some very concerned people. But when I explained the facts, they were fine. But they got very nervous.
Communication in crisis is important.
Yeah.
It's no small feat that the thing that you built survives today as Canaccord Genuity in an environment where we have seen nothing but some of these smaller shops completely disappear. And the financing environment for smaller companies kind of slowly dry up in this country. I'd love to get your thoughts on why you think that is, and ultimately what it takes to win if you're not going to be one of the banks in this space.
Well, why that is because the industry has consolidated. When I started in the business, it was a partnership-owned industry. The banks were able to take over the leading investment dealers in 87, 88. And it took quite a while for consolidation, but the driving factor is the lifeblood of the investment banking industry, generally speaking, are underwriting fees. Underwriting equity issues and the commissions that go with that. And if you're not able to participate in that, you really are not able to pay for research or sales and trading, at least in a very material way. And unfortunately, the bank's portion of the underwriting syndicates have gone from, I'm going to say 20 years ago, it would have been well below, or 25 years ago, well below 50%. To today, it would be closer to 90% plus, maybe 95%. And the syndicates that are led by the banks look a lot like their loan syndicates and debt syndicates, which basically shuts out all the independent dealers. And, that's the number one reason why there's less liquidity for small caps. There's less ability to research those companies. And, so you have a very, very consolidated industry.
I mean, that has consequences for innovation in this country if there's no capital to fund it.
It does. And, look, obviously, I'm now full-time exec chair of Outcome, and I stepped down. I'm chairman emeritus of Canaccord Genuity and stepped down. But, as a long-term industry participant, I don't think that's good for the Canadian capital markets. I don't think it's good for entrepreneurialism and innovation. And, it's nobody's fault per se. Everybody's doing, what's in their own interests. So I don't fault the banks per se, but what we need, in my opinion, is a empowered and vigilant regulator that says this is not in the best interests of the country and the capital markets and innovation. And, I can give you some pretty tangible ideas about how to deal with it, but to basically get back to where you could have many more independent investment dealers and competition and research and sales and trading. It doesn't work if there's only 6 banks left who basically do the same thing and basically trade with each other. There's no trading left in the market. I mean, I remember being struck. I was working on the British privatizations back in the 80s, and I remember in order to leverage off of that, we were doing other international equity offerings for other European companies. And I remember Swiss Bank Corporation, which is, what would now be part of UBS after all their consolidation.
Yes.
I remember we were doing a private placement for Swiss Bank Corporation to Canadian institutions and doing due diligence there. And I was in Zurich. And just before meeting with the CEO a due diligence session, I saw one of their branches and it said trading today at 3:00 as a sign in the branch, in the window. So I got to the session and I asked the CEO, I said, by the way, I noticed in one of your branches, it said trading today at 3:00. I said, what does that mean? He says, well, 4 times, I think it was 4 times a week, we trade at 3:00. And everybody, and I said, how is that? And he says, well, there's only like 7 or 8 companies that act for clients, and we don't need to have the overhead associated with
a trading desk
and research, et cetera. So we just all get together at 3:00 and, do our client orders then. Well, that's pretty much, reductio ad absurdum, but that's pretty much where one's heading if you only end up with a handful of institutions and there's nobody left to trade with. And it also goes to the buy side of the industry where, again, 90% of the industry is dominated by the banks, who for good and valid reasons have, a lot of strict parameters of what they can do. And there's not much of a small cap market left.
For a decade, the Murray Wealth Group has been dedicated to disciplined, long-term investing. The result? Their global equity growth fund boasts an impressive 14% compound return since inception, and they're proud to celebrate their 10-year anniversary of building wealth for investors across Canada. Discover how the Murray Wealth Group can work for you by visiting murraywealthgroup.com. World-class investing, wealth built together. So how do you fight for space?
Canaccord Genuity has done pretty well. Ironically, I think it's actually benefited us in a way because we're I don't want to say the only, but by far the most successful, where, we've even led the league tables in certain years. And basically we focused on industries and companies where credit is not critical. Because if you borrow money from the banks, they're going to say, I want your business and all of these other sectors, including equity and M&A. Most people would say, David, what are you complaining about? You're the one who started it in 1993, because that was my strategy then for CIBC. But when you're the only one doing it, it's kind of an opportunity. When everybody's doing it, it doesn't work well for the industry. So we've focused on the most entrepreneurial sectors. We also have a very strong cross-border capability in the U.S., UK, Australia, and we've leveraged off of that. Very strong on M&A. So we've leveraged off of that, to have a fairly successful Canadian franchise. But the number one priority, frankly, for Canaccord Genuity was growing the wealth management business. That's why, I did the deal in 2010 to form Canaccord Genuity. And we basically went from, a negligible amount of wealth assets under management and administration to about Canaccord Genuity would be about 120 billion today.
And that provides the stability, right? So then Cycles can do whatever it wants, and at least
it's a
you have
much
the
more
stability.
stable and growing business. And and in that case, about I may have the number slightly wrong, but about 45 billion of that would be in Canada, about 10 billion and growing in Australia, and what's that, 55? So, call it 65, 70 billion in the UK.
And yet, I know you were just complaining about sort of the buy side, and I know Canaccord has been sort of like saying they're not getting a fair shake in the public markets about, what their business is worth. Is the buy side, interested in kind of these nuanced type of stories? Is there enough capital there to support these kind of independent stories?
In the public markets?
Yeah.
No. Frankly, it's anecdotal. AI gets hot. You can do some AI. When cannabis was hot, you can do some cannabis. But the sustainability of the capital, is really not, there's not enough buy-side players. And one of the main reasons is because there's not enough liquidity, because there's not enough trading desks, because there's not enough research. So, when that goes away, when I started in the business, the new issue market was entirely retail. Institutions were just emerging, if you can believe it.
So not buying IPOs.
When I did IPOs for Wood Gundy for clients that where I was the leading investment banker for Wood Gundy, we used to go across the country to all of our branches, and then we do
to sell stock.
And you'd have a syndicate with 5 to 10 other investment dealers, because you wanted broad distribution, because that was in the interest of the client. And that's what makes a market, if you will. So the industry, obviously, in addition to consolidating, got very institutionalized, and institutions get big and they don't want to own a small amount of a company that they can't trade in or is illiquid. So it makes it very challenging.
We talked about career highs, and obviously, setting in motion, Genuity was one of them. But I also think it's valuable for people to learn from successful people, not just their successes, but some of their biggest mistakes, their biggest failures. Do you want to talk about one of those?
Well, first of all, do we have a week?
Yeah. Let's get into it. It's a podcast. I
don't think we have enough time left for all the mistakes. I guess first of all, I'd say this about mistakes, and I've made a lot of them. I try not to make the same mistake twice. I always find new mistakes to make. That would be number one. But if you're aiming high and out of your comfort zone, by definition, you're going to end up making mistakes as you try new things or think new thoughts, etc. The most salient mistakes that stay with you are as a principal, where you invested in something and you'd say, boy, I wish I could do that all over again.
Like what? You got to give me a name, an example.
Of an example?
Something that went wrong.
Oh my God. Probably be on the investing front on a personal note. One that comes to mind. I've done a lot of angel investing. That's easy, because it doesn't involve other people. So I've done a lot of angel investing. And rather than pick an individual investment, I'll say what's worked and what hasn't worked. So after I left CIBC, so for 15 years, I was investing on behalf of the bank. After I left, so starting in March 2004, I started getting approached about investing directly for myself, which I did. And I guess two things happened that would be big learning. Number one, the first 4 investments I made were really successful. And the first one was about a 15, 20 bagger.
What was it? Would I know it?
Well, I don't know if you know. It was a company. And so I was trying to do good. I was interested in doing good. It was a company called Sky Power.
Okay.
That was in wind and then ultimately solar energy. So it actually did very well. We ended up that's another long story. We were going to sell it to Iberdrola, which was the leading wind solar company in the world out of Spain. Ended up selling it to Lehman Brothers just prior to the financial crisis, a year prior.
I guess that tells us what happened to Lehman Brothers.
That's a really interesting story, but
you can tell it to me if it's really interesting. I'd love to hear it. Before the crash?
Yeah. Well, I'll finish and then I'll come back to that. So the things I would have gleaned is, number one, don't let your investments pick you. Anybody in the professional investing business would say, go out and be proactive. And as an individual, since I was working full time, whether it was at Genuity or then Canaccord Genuity, I didn't have time to do that. So basically the investments were picking me, at least as an angel investor. And the second thing I would notice is that anything where I had the time and attention to make a real decision tended to do a lot better than friends saying, I'm investing in this, David, would you invest with me? They tended to be the worst, would be the two themes that, so if I would do it all over again, I wouldn't let investments pick me, and I wouldn't invest with friends just because they said, and unless I had the time to independently decide, as opposed to, oh, so-and-so's doing this, okay, so I'll throw in some money.
Okay, now we have to go back to that Lehman story.
Okay.
What happened
it's
there?
a lesson about the financial crisis, actually, so it makes it kind of interesting. March 2004, I invested in Sky Power, which was a tiny little business at the time, fledgling. And the entrepreneur who I had dealt with while I was at CIBC World Markets, and we had invested in a prior company of his, asked me to come in, be the chair, be his advisor, and help him with the business. So I agreed to do that, and I think I took a 20% interest. One of the great lessons, in getting from here to there, where I had to get him to stop his worst instinct, was he always wanted to raise money and make it bigger quicker. And I kept saying, the goal is not to raise money and make it bigger quicker. The goal is to maximize the value of your investment. And what good is having a company that's 10 times bigger where you end up owning 1% as opposed to end up owning a company that's twice as big where you own 50%? Obviously, anybody could do the math. So I spent a lot of time getting him not to do things that he wanted to do more quickly than he should have. Long story short, we did manage to do that. He grew the business. All credit to him, a terrific entrepreneur. He grew the business, and the business was the wind and then solar business, but wind at the time was consolidating very quickly. In order to grow in that business, all of a sudden you needed to have hundreds of millions of dollars to buy the wind turbines from GE or to get the purchase power contract from some big utility or government, et cetera. So he said, look, this is consolidating really quickly and vastly exceeds what we can afford. So why don't we sell the business? I said, great, which obviously my expertise. So we went ahead, we did an auction. Canaccord Genuity, or at the time, Genuity acted for him. And we thought we were going to sell it to Iberdrola, which is the largest wind company in the world at the time. Out of the blue, Lehman Brothers calls us up. I guess they had heard about this. Lehman Brothers, the investment bank,
yes, saying,
we hear you're selling Sky Power. We'd like to buy it. We were selling it for, sort of about $125 million, with earnout to Iberdrola, and Lehman comes in and says, "We'll buy 50% for $100 million, and you'll retain an interest, which ultimately you'll exit when we exit." So obviously that was a better deal. So I said,
Did you ask?
yes. I'm going to get to that. So I said, really? And, okay. So ultimately, we negotiated a deal with them, and it culminated with the final go or no go at their offices on 7th Avenue. They were in new offices, which is now, I think, BNP Paribas, ironically, one of my wife's clients. And we were on 7th Avenue, and we were being entertained, the CEO and myself, at the top of the office tower in their lunchroom with all their senior executives. So none of the guys on the deal team, all their senior executives, including Theodore Roosevelt IV, who was their,
I know that guy. I've interviewed him, and he does do a lot of green energy investment.
Nice guy.
Yeah, okay.
And their head of risk and their head of merchant, et cetera, et cetera. And I think Dick Fold poked his head in for about 10 minutes or whatever. Now, I'm not sure they realized who I was. As Sky Power, they wouldn't have known. Genuity would have been tiny. They wouldn't have known who Genuity was, but I was chairman and CEO of CIBC World Markets. And Lehman was a real competitor. In fact, we actually exceeded them in the league tables in the year 2000. We beat them out on the equity and M&A league tables that year, I think. But obviously it didn't register with their senior people. So I started asking them questions. And I said, so let me understand this. You're an investment bank and you want to buy, basically an illiquid wind. I said, why? Well, Goldman Sachs did a deal where they had done a deal where they invested in Horizon. I think it was Horizon Energy Partners, if memory serves me. I may have the name wrong, and did very well on it. They got in, they got out, and they made a lot of money. And one thing you needed to know about Lehman is they had a bit of Goldman envy. So whenever Goldman did something really well, they wanted to, they wanted to do it as well. And I can safely say this now because Lehman doesn't exist.
Yes.
They kind of had that reputation. I said, so what fund are you putting? You must have a fund. Oh, we don't have a fund, but we're thinking of doing one. So I said, where are you going to put this? And they said, on our balance sheet. And I had run an investment bank. I was regulated by both the SEC and the New York Fed. They would be the SEC because they weren't a bank.
Yeah.
They were an investment bank. So I said, on your balance sheet, I said, how many other assets do you have like this? And I think at the time the answer was about 15, 20 billion.
Of illiquid
private investments. I said, how much capital do you have? And they, and I may have this slightly wrong, but the common equity was about 15, 20 billion. And they said, well, only 15, 20 billion. So one to one. I said, but, we have 75 billion of borrowing capacity, commercial paper, basically.
As long as the market stays.
And I said, really? I said, so you're levered, so how much you levered? And at the time they were levered something like 30 or 35 to 1. And I'm thinking to myself, wow.
Tell me you went out and shorted Lehman Brothers.
So I didn't.
Okay.
But, and in 2000, this took place, I believe it was June 2007. So a year and change prior. And, everything was still really rosy. I believe the credit market cracked in the summer of 2007. I remember one deal I was working on for investment banking client for Genuity just disappeared because the credit disappeared.
Wow.
in the summer of 2007. And I'm thinking to myself, this is not going to end well. Now, at the time, it looked like it could go on forever. Of course, it never does. So no, I did not short Lehman Brothers, but a year and a quarter later, I remember thinking to myself, this was predictable. And I think that, other than I don't think that was very responsible management.
Yeah.
My biggest takeaway was, where the hell was the SEC in this?
I feel like a lot of people were asking that after the financial crisis.
They're regular, and there they were, giving out parking tickets to individual stockbrokers, but you had this terrible thing going on in their watch, where they weren't looking at the macro picture. They thought all these firms were fine.
I wonder if that taught you something about, like reading those signs when they're right there in front of you. Like you said, like the music was still playing. So you're like, oh, maybe it's fine. And I just don't know why it's fine.
What do I infer today from what was happening then? I don't know when the next accident is going to happen or what it's going to be, but it won't surprise me if it's to do with private credit.
Tell me why.
The guys who are the best at it are really good at it. Including HPS, which is our partner in Canaccord Genuity's partner in our UK wealth management. So those that are industry leaders are really good at it. But there are a lot of players getting into it who are not quite so good at it.
And private credit is basically, if you want a loan, you can go to the bank. But now there are companies that are set up and saying, well, I'll just give you a loan, as opposed to private equity, right?
Yeah,
it's private debt.
Well, the problem with, and I'd say this by and large of the whole private alternative asset management business generally, is the industry used to be, when I started in it, and I'm going way back, it used to be about earning carried interest, which was performance fees, essentially, on doing a great job for the limited partners. Today, the industry has evolved where the trick is to get as much assets under management as quickly and as much as possible, because you are now valued based on your steady stream of those base management fees, which when the industry started, didn't even matter. They were basically just cost recovery. And the base management fees today are what drive the valuations of the very biggest firms, and the smaller and emerging firms want a piece of that action.
So you're confident in the larger firms, it sounds like, the ones who've been doing it for a while?
More so, because I think they're really good at what they do. Having said that, when you're part of an industry where things start to go south, are they going to be okay? Sure. Could their valuations go down? Yes. Because, all of a sudden they're as good as the next large fund they raise. If all of a sudden the sheen goes off of private assets and there's a hiatus period, then, that's challenging for the entire indry.
And they're luring people in and saying 8%, 10%, returns.
Well, until it's not.
And exactly. And everybody needs, portions of your portfolio and alternative. And I feel like what they sweep under the rug is like lack of liquidity, and they're not really marking to market regularly.
Yeah. So a quick plug for Outcome, since we haven't talked about Outcome. We actually have a new bond strategy that Noah Solomon and I, working together, developed a couple of years ago. Noah's the genius that is the portfolio manager and CIO, CEO. But, we developed together, in part based on my experience of what I think the biggest trouble spots in the fixed income world. So we're just launching a fund that I think is best of class, certainly for the broader retail investor.
That avoids what landmines?
It avoids a liquidity landmine. Because when things dry up, the mark that you had at 100 or 90 is all of a sudden, worth 60 if you can get it off at all and be completely illiquid, which is when, fund managers throw up gates and they can't, because they can't handle the redemptions. This strategy is based on the most liquid ETFs in the world. And the other thing I really like about it is it's dynamic, which it changes monthly and pushing the credit and the duration levers, to adjust to what's going on in the market. And if you look at what's going on in the world right now, starting from the US and its president, it's really uncertain as to what's going on in fixed income world and how this is going to unfold and in an exchange market world.
just so I'm clear, could the accident be like a spike up in rates?
Yeah. We could be in a very inflationary market. I don't know, but there's a lot of volatility, which suggests there's going to be a lot bigger premium given that uncertainty and how this unfolds. And even if the tariff policies settle down at some point, but there are tariffs, we are in a new world. These tariffs, even at the baseline of 10%, are several times as high. So we are in a whole new world for different industries and, the companies in that industry and what their results are and what supply chains look like and what trading looks like. So, who knows how that unfolds? Usually when that occurs, there's less liquidity and greater risk, and that shows up in premiums on interest as well as in equities.
Well, it's great to get that sort of on our radar, but you also touched on kind of the political environment right now. And as we're wrapping up the show, because you have been around the block when it comes to building businesses and doing deals and creating value in this country, we're at a moment in this country where we can possibly decide, is the next 10 years going to be like the last 10 years, which from an economic perspective, were pretty disappointing. And I'm wondering, you have a clear vision of maybe how we can juice the capital markets so that smaller companies get funding. But do you have any big picture views or advice or thoughts in terms of the direction you'd like to see the country headed?
For Canada.
Yeah. I thought you might.
Yeah. And I think Mark gets a lot of this really well. So, kudos to him. And I have a good relationship with Michael Sabia, and I think having him in that seat is great. He's an extremely bright, capable person. So that's all very positive. I would love to see us have a real industrial strategy, which I think we're going to have, which probably includes, which is in the headlines, LNG, having trading relationships with countries other than the U.S. Not that we should not have it with the U.S., but be more diversified. I'd love to see us doing a lot more about entrepreneurial innovation, sectors of the economy. We are, whether we like it or not, we're the land of the oligopoly. I think we've been very well served by that. So, contrary to what I said earlier, I think having a really stable banking sector and telecom sector and et cetera, is good for Canada, which is a small, geographically inefficient country. So I think that's actually very helpful. But having said that, innovation is not going to come from those oligopolies. That's just not the way it is. So what we need is to nurture, protect, allow, and facilitate emerging industries and do everything we can to have them grow into big companies as opposed to sell out right away to the bigger company in the US. So I'd love to see that happen. I think people are a big deal. We're in a moment in time where all of a sudden Canada is a wonderful place to be. If you're a researcher or a professor or a tech person or a biologist, et cetera, I just say U of T, I think, was just ranked number 16 in the world. McGill's very highly ranked. I think we've got a great university system. We can be attracting these people, and we should be doing everything we can to bring them in. And the brain drain has been the number one issue for most of my career going to the U.S. We are in a moment in time where we can reverse that and have a compelling offer to that type of intellectual capital. So I think the third thing I'd say is, immigration has been the number one issue driving politics in the world. Just read a couple of great books on that. Canada does immigration about as well as any country in the world. It is a huge part of our fabric. I don't think it was done particularly well the last few years, with apologies to the Trudeau government, but nothing succeeds like excess. But we culturally embrace it. We do it well, and I think we can turn that and treat that as the advantage that it is for us, and do a great job on immigration.
David, it was so great to spend time with you. Thank you so much for being so generous with your time and your insights.
Thank you very much. It was a pleasure to be here.
That was David Kassie, and we'll see you on the next episode.